Welcome back. In this video, we are going to understand what is a stock index, and we are also going to look at how the stock index is calculated. Stock index is a number that represents a particular section of the stock market. Usually, it is seen as the leading measure representing the entire stock market. Very often, you will see one stock index associated with an exchange which represents the leading stocks trading on the exchange. Stock indices are widely quoted in the press and tracked by the public as they reflect the prevailing sentiment in the economy. Stock indices are also used as a benchmark for determining if a fund manager has added value by selecting stocks for a fund. By subtracting the yearly return of the stock index from the fund manager's annual return, you can arrive at alpha, which is a measure of value added by the fund manager due to his stock selection skills. Stock index is just one out of many different types of indices. For example, one can create an index from price of stocks of all banking companies to represent a banking index, or one may create a real estate index from price of stocks of real estate companies. Now let's look at how the value of an index can be calculated. There are primarily two ways of calculating the value of any index. These include the price weighted index and the capitalization weighted index. Let's look at the price weighted index first. In case of the price weighted index, the value of the index is calculated by adding the price of each stock and dividing the sum total by the number of stocks. So you essentially add the prices of all the stocks that constitutes the index and divide it by the number of stocks that are in the index. This implies that a stock with higher price has a greater influence on the value of the index compared to a stock with lower price. So for example, if a stock A is trading at 10 and another stock B is trading at 10,000, and suppose if only these two stocks are used to create an index, then the value of index is given by 10 plus 10,000 divided by 2. So the value of index comes to 5005. Now if suppose stock A were to move by 10% while stock B remains unchanged, the new value of the index would be 11 plus 10,000 by 2, which comes to 5005.5. On the other hand, if stock A remains unchanged while stock B moves by 10%, then the new value of the index will be 5505. Since both the stocks are given equal weight, the same percentage move in stock B may move the index more than the corresponding percentage move in stock A. So the key drawback with price weighted index is that a stock with higher price dominates the movement in the index, and so such an index is not truly representative of the stock market. In order to avoid this, indices are often calculated using the capitalization weighted method. A capitalization weighted index is also known as market weighted index. In case of capitalization weighted index, the market cap of the stock is used to determine the weight of each stock in the index. This ensures that a stock with greater market capitalization has greater influence on the index. So in case of this example, if stock A has 100,000 stocks issued while stock B has only 10 stock issued, then the market capitalization of stock A would be 1 million, while that of stock B will be 100,000. We will use each stock's market cap and divide by the total market cap of the index constituents. So in this case, the total market cap would be 1.1 million. In order to arrive at the index, the weight of each stock would be calculated by dividing the stock's market cap to the total market cap. So stock A gets a weight of 1 million divided by 1.1 million, which is 10 by 11. Similarly, stock B gets a weight of 100,000 divided by 1.1 million or 1 by 11. So now it is easy to see that a stock with higher price cannot simply dominate the index. Now that we have covered the basics of stocks and stock exchanges, in the next section we are going to answer some of the common queries related to practical stock trading. So see you in the next section.